Do you want to receive money without doing anything? Do you want to retire early but don't know where to start? In this video, I'll share my top tips for using dividends to achieve your retirement dreams. Hello my friends, what is up? Before I begin, if you're new to this channel, my name is Keeley. I started this channel so that I could share my financial journey with others and to hold myself accountable for my financial decisions. So what are dividends? They are payments of companies' profits to shareholders. When a big established company earns a profit, the board of directors can approve a plan to share those profits in a form of dividend, which is typically paid out in cash or additional shares of stock. These kinds of companies are known as blue chips. Apple, Coca-Cola, Johnson & Johnson are examples of blue chips. These companies are usually stable and their growth have slowed. This is different from growth stocks, where these companies invest their profits back into their business for growth. Shareholders then earn from a potential increase in stock price. Tesla, Netflix, and Amazon are examples of growth stocks. For Singaporeans, dividend income is not taxable. However, do take note that any dividend income derived from the US is subjected to a 30% withholding tax. For US citizens, you need to own the stocks for 60 days before the ex-dividend date to be taxed at the long-term capital gains rate. If you hold the stock for less than 60 days before the ex-dividend date, it will be taxed at regular income tax rate. Aside from dividend stocks, you can also invest in real estates. I know, owning a real estate can be very expensive for many people. So instead of owning your own real estate, you can choose to invest in real estate investment trust or REITs. Investing in REITs provides stable cash flows for you because they are required to pay 90% of their taxable income to shareholders.
I have a friend who writes articles and deep dive into REITs. From his post, you can get more information on the key metrics, DPO, occupancy, gearing ratio, interest coverage, and other fundamentals. If you're interested in reading his analysis, check out the link in the description box below.
Dividend income is a source of passive income. This means that you can receive regular income without having to actively work for it. This is very important in your retirement when you do not have a steady source of income. Dividend stocks can provide a reliable stream of cash flow. So aside from this, some dividend stocks have a track record of increasing their dividends over time to reward shareholders, as well as to keep up with inflation. Dividend Reinvestment Program, or DRIP, is a program that allows you to reinvest your cash dividends into additional shares on the dividend payment date. Reinvesting your dividends will compound your returns and holdings. Check out this video here where I talk about the power of compounding and the snowball effect. Value of a fixed income stream may decrease over time due to inflation, resulting in the interest payment from existing fixed income asset becomes less competitive relative to newer, higher rates fixed income assets. Now, companies may increase their dividends payout to keep up with inflation. Furthermore, dividend-paying stocks can be an attractive investment option to generate income without touching your principal. With a high enough dividend yield, you can receive a significant amount of income without having to dip into your savings.
I've created a Google spreadsheet that helps to track the dividends for the year. In column B, enter the stock ticker here and the company's name will appear in column A. For dividend-related columns, you can refer to columns L, N, O, and P. There are also other details that could be useful in your portfolio tracking. By entering the number of shares you own and the average cost, column H will show your current total capital invested, and column I will show your current fair market value. This will populate your profit or loss in monetary or percentage term in columns J and K respectively. If you want a copy of this spreadsheet, check out the link in the description box below.
First common mistake is to focus on high-yield dividend stocks. This makes sense because you want income. However, we do not know if this yield is sustainable or not. A high yield may not always be a good thing. Investing in high-yield dividend stocks can be risky as it may lead to an inclusion of lower quality stocks with unsustainable yields. You should instead look for companies with a history of consistent dividend payments and dividend growth. This can provide more stable and sustainable returns over the long term. A high dividend yield could also indicate that the company is struggling and is using the dividends to attract investors. If the company is not doing well, it may not be a good investment, regardless of the dividend yield, and sometimes it might lead to a potential loss of capital. The next common mistake is timing the market. The problem with this approach is that it is very difficult, if not impossible, to predict market movement accurately and consistently. If you take a look at Apple's chart from the first quarter of 2020, we see price dropping from the highs of 80s to a low of 50s. In a typical investor's experience, they might see price dropping. They will wait and see before they buy. When price rallied, they might think that this is a dead cat bounce before a crash. And yes, sometimes they will be right and feel smart for not buying previously. They are overconfident of their prediction skills and plan to buy at a large discount. In this case, $50. However, price did not reach investors' entry price at $50. They would have missed out on an entire bull run up to 180s. Therefore, it is generally advisable for you to focus on a long-term investment strategy that involves buying and holding a diversified portfolio of stocks rather than attempting to time the market. Having a steady flow of cash flow at retirement is important. It removes the negative psychological effects it will have on you. The last thing you want to worry about at retirement is not having enough money to pay off for your lifestyle. Insufficient planning may result to you ending your retirement early and going back to find a job because you do not have enough money to survive. I hope you have learned something new today. If you did, do click the like button, comment on what you have learned, and share this video with your friends and family. I post videos on personal finance and updates on my personal portfolio. If you like this content, subscribe to me and turn on the notification bell. You will get notified when I post more content in the future. I'll see you in the next video.